Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, May 31st, 5:02 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, large cap uptrend, led mainly by tech, avoiding regional banks and anything related to commercial real estate. Regional banks taking another hit today on some cautious comments by the FDIC. Let's check over here at the trend gauge. Leaders acting fine. Short term, still above the 21-day moving average with the S&P 500 and the NASDAQ 100, but being dragged down by weakness in small caps, mid caps, and the Dow. You got to see the yellow sub arrow there. Medium term neutral, S&P and NASDAQ above our medium term 50-day moving average, small caps, mid cap, and Dow below it or playing tag with it. Long term, the big three indexes, big cap indexes, S&P, NASDAQ 100, and the Dow above the 200-day moving average, mid cap and small cap below. So we're neutral there also. So what happened today? Week open, we gapped down about 0.5% and then basically put in a tight cup base most of the day. There was some weakness when the FDIC made some cautionary comments. There was some weakness when one of the Fed heads said there's no reason to pause raising, but then later in the day, a couple of Fed heads came out and said, I think we should just pause and wait and see what data comes in. Before the open, there was some very disappointing economic data, an increase in the number of job openings and a big drop in Chicago PMI, pointing to an extreme weakness in the economy. So the Fed, obviously, they're worried about doing too much, going too far, and really crushing the economy, trying to engineer a soft landing here. But the economy is so big and has so many cross currents and so complex, it's really hard to say what should be done. So gap down in base, the S&P 500 broke below that and closed below that 4,200 level. That's not good, but all is not lost. We'll take a look at the charts and see what it means. Second straight day of a significant pullback in semiconductors also, with the exception of Intel, which raised, or they were at a conference and they pointed their guidance to the upper part of the analyst range, and that rallied about 5%. So here are the numbers on the day. RG8, this is our 8 ETF growth composite, down 0.67 on the day. Would have been worse, except ARK-K. Some of the top holdings in there had good days. ARK-K was up 1.7%. So net down 0.7. S&P 500 down 0.61. NASDAQ 100 down about the same. Dow down 0.4. Mid caps down 1.4. Russell down 1%. Global 60/40 down 0.28%. Developed nation foreign stocks down about in line with the S&P. Bonds rallying for the second straight day. Made this the best performer on the board. In-house down 0.45%. Our hedge, which we added some to, doing its job as some of the extended big seven of the NASDAQ pull back to more reasonable ranges. We'll hit the tail of the tape in its weekly chart Wednesday. We'll go through the 21/21 on a weekly basis. Got 5 of them in the area of breaking the 21, actually 4. Uber undercut but reclaimed with a nice close at the end of the day, and Tesla with a very nice close at the end of the day today. So let's dive right into it. We'll start off here with the S&P 500. You can see the two big moves higher last Thursday and Friday off of NVIDIA's earnings report. Irrational exuberance Monday with the gap up and reversal, closed right above that 4,200 level, and then the gap down today closed mid-range, bounced at the ADMA, actually undercut and reclaimed the ADMA. This is kind of normal. You can see if you count the move off the bottom from last Wednesday, 3-4 days up, The pullback, we haven't even retraced 50% of that move, so reasonable pullback at this point. Let's go to the NASDAQ 100, obviously a much bigger move up off of Wednesday's low, and a lesser of a pullback. Uh, Again, gapped up yesterday. Irrational exuberance closed near the bottom of the range, filled the gap from Friday. Today, really nothing wrong with this action. Still significantly above the moving averages, 1.8% above the ADMA. That's the most likely place for it to meet up first. Let's see, yesterday we closed 3%, so we're closing the gap by about 1%. That'll be close to today's low, about 1% below today's low by the opening tomorrow. 21-day moving average and 50-day moving average continue to move up at a nice clip. The good thing about that is, as I talked about Friday with the two numbers that I really liked, is these present higher levels of support the higher they go, including, and now we're right into the breakout area on the 50-day moving average. Still pretty extended from the 50-day, over 8%. But yesterday we were 9%. So chopping that down about 1% a day. We just need some sideways action here on the NASDAQ 100 to work off that. I keep calling it irrational exuberance because really that's about what it was. Not to belittle the impact of AI, but you can go too far too fast. Dow Jones Industrial Average pulled back again, bounced at the 200-day moving average. A little bit of relative strength today versus the S&P 500. Now here's where we had held some hope, but not today. That FDIC comment put a hit out on mid caps and small caps as it impacted KRE and KBE. Although they did finish, let's see, about a little over 1% off their lows, so that's good enough, I guess. But closing lows going back to basically the beginning of the month, so closing the month near the lows of the month. Not a good close for MDY. Let's look at small caps, IWM. A little bit better relative to the lows. So you can see it's outperforming mid caps, not outperforming the S&P. Failed again at this 50 and 21-day moving average. Not good. But giving it some time, relative strength making a lower low. Look where the price is versus to the last time the relative strength was this low. Relative strength making new low before prices, never a good thing. Let's flip to the VIX now. Back above the 21-day moving average. Inside day for it today ran into the declining 50-day. Not really a big deal here, up 2.8%. The dollar, stronger early in the day, came off when some of those Fed speakers started talking about pausing. You can see how it was strong early, sold off the close near the lows of the day, despite still staying positive. Now, the thing that was a bit strange about today was dollar gapping up and seeing strength in the precious metal stock. So here's GLD. This was green all day. Wow, that really pulled back a lot. Closed near the lows of the day, was up to 183.44, closing at 182.32. So that's interesting. Look at that, gap up, stayed strong, and then pulling back while the dollar was pulling back. So correlated today, the opposite of what has been happening recently with gold. But this is a pretty weak chart below the declining 21-day moving average. How about GDX, gold stocks? Strong all day, up 2.35%. Pulled back about 1% off their lows, ran into the declining ADMA. This 30 area is looking like support for them. Silver, 1.4% regaining the ADMA. Let's flip to bonds now. Broad bond index, BND. Bonds were up across the board again, second straight day after a pretty harsh 2-week pullback. Up 1/3%. TLT, the long term, up 0.87%. Let's go to the 10-year yield. down for the second straight day, 1.7%. Again, retracing this big move up over the prior 2 weeks. And TYX, the 30-year yield, down again for the second day, breaking the 21 EMA, breaking this uptrend line. Uh, this pullback it's been explained. The media is explaining it's due to the agreement with the debt ceiling. We'll see. Don't know if we need an explanation necessarily, but things don't go straight up. Bitcoin giving back some of yesterday's gains, down 3.7%. And that's enough on inter-asset correlation today. Let's go to the tail of the tape. You can pause it here to read the whole thing. So the news, Chicago PMI 40 versus 47, a big miss. JOLTS, uh, over 800,000 additional job openings versus what was expecting. And then Fed speakers with a mixed message. FOMC, beginning of the day, was pricing in a 73% increase of 25 basis points. By the end of the day, it was down to 36%. As a couple of those speakers said, I think we can pause and wait for some data. The day count, we're up to with a 2-day consolidation. Never go straight up. These consolidations are normal. Third day above the 80 MA, which we actually undercut and reclaimed. Fourth day above the 21 EMA. Expectations remain positive as long as the S&P and the NASDAQ stay above their 21 EMA. As I said, all day tight cup base. Let's look at the S&P real quick on a 5-minute chart here so you can see what I'm talking about. There's the gap down. Here's the cup, the handle, the attempted breakout late in the day, but then a sell-off late in the day. But while we were selling off late in the day, some money came into Tesla with some volume. You can see this big close on Tesla, cup and handle not fading all the way up to the 204 level, back to 203 after hours, but there was some volume with that too. And it got back above the 200 level and the 200-day moving average, making a higher high. Again, note the relative strength over the last 2 weeks on this since the change in character occurred after 517 at the shareholder meeting. So relative strength, volume, back above the 200-day moving average to the top of its base, and it's a stage 1 base, which is you love the stage 1 bases if you're an O'Neill follower. And Tesla certainly has the power to lead a market higher. We've seen it multiple times. So what was strong today? The defensive names, XLP, UV, and RE, that's staples, utilities, healthcare, and real estate. SPLV, low volatility, up on the day. Let's take a look at that chart, as that had been lagging with high beta leading it, but bouncing at the 60 area, you can't go straight down. Reasonable spot for a bounce. SPHB, high beta, looks a lot like the semiconductor chart with a negative reversal, and then another gap down today, but finishing mid-range, bouncing off the 80 MA. Looks more like the S&P 500 actually. Okay, back here. What did we do today, or what was weak? Oil, semiconductors, KRE. Let's take a look at that after 5-minute chart here, and you can see the comments coming out. Actually, early in the day it was, but then we bottomed somewhat early and then worked our way sideways, a big L-shaped pattern. Failing into the 40 level, back below the 21-day moving average after trying to put in the bottom of the base. So that's KRE. Semiconductors week. Let's go to SOX and SMH, the two major ETFs. Here, SOX day 2, still quite a bit away from the ADMA. SMH down 2.6%, SMH down 2.5%. This is more heavily weighted with NVIDIA after the 3-day big move up after NVIDIA's earnings. Just giving back some of that move. This is pretty normal. See what happens when it hits the ADMA. And retail, before the open, advanced auto parts, you can see retail. Look at this, breaking to new recent lows going all the way back to October. This is one of the worst looking charts. Not really a surprise when you consider the supposed looming recession. But AAP, Advanced Auto Parts, just taken apart, down 35% today. Badly missed on earnings, lowered their guidance, and cut their dividend by 80%. I know there's a lot of dividend investors out there that don't care about the balance in their account as long as they get their dividend, but now your dividend's cut 80% and your stock has been more than cut in half. What are you going to do then, dividend investors? Let's wrap this up now. Portfolio changes. We added to SQQQ on the early weakness, took a little bit of it off toward the end of the day, added to AMD and DT. AMD got back that 1% that we sold within a couple of pennies of where we sold it, much less risk now, and DT continues to act well. Bottom line, a little bit of reduction in beta for the portfolio, and the bottom line on the day, gap down, all-day cup base, S&P 500 below 4,200, day two of the great semiconductor pullback after the uh, irrational exuberance caused by NVIDIA after last Wednesday's close. So there's the tail of the tape. Let's hit the 21 over 21 on a weekly chart. First, we'll take a look at daily charts of the ones that I noted that undercut the 21 today. The first one being Uber, which we have a good size on. Undercut the 21, ended up bouncing at the 21 into the declining ADMA. All in all, a good close, up 1% on above average volume. Intuitive Surgical has been on this list for a while. Nice earnings gap up, undercut, bounced at the 300 level back above the 21, so that reclaimed. Shopify closed below the 21. Relative weakness since that 3-day move on the gap up. So that's number one, closing below the 21. Race has been consolidating, pulling back, second close below the 21 after its earnings gap up. Lack of relative strength also, and DraftKings undercut but reclaimed the 21. So we got 3 of the 5 that undercut, reclaimed the 21 by the close, only 2 closing below. Let's go to the weekly outlook. For the 21 over 21, we'll go to the weekly chart view and we'll start with what we own. These all have red flags next to them. And then we'll wrap up with what we don't own, but is in the 21 over 21. So you can see Microsoft, really nice. After its earnings gap up and its 3 weeks tight, continuing higher, normal consolidation up near the highs at 340 here. Meta continues to just work its way higher after earnings. NVIDIA, normal pullback after the big volume up. Look at the relative strength all year on that stock. Uber, flagging nicely after its earnings move up. AMD pulling back after a big move up with sympathy after money flowed into it on the NVIDIA news. Chipotle, tight action after its earnings move higher. DT continues to act well, trend higher, nice volume. It only has about a 2% ATR each day. This is, I wish they all acted like this and traded this tightly. Relative strength confirming the price action. Tesla, strength came in today, close above the 40-week and the 200-day moving average. Good stuff there on Tesla. And Google, we added this week, inside week so far for Google after its earnings move higher. Here's the NASDAQ 100. We're showing this because of the short that we have against this normal pullback so far. It can come back further, and that's fine. Our gains in SQQQ will offset some of the losses that we have in the big NASDAQ stocks that we own. Now the rest of the portfolio. Shopify, this doesn't look good. This isn't what you want 4 weeks back after an earnings move higher. We talked about how it closed below the 21 today. Race, pullback now to the 10-week moving average after a 3 weeks tight, a little bit more pullback than you'd want. DraftKings hasn't shown any strength. In fact, a false breakout after a big upgrade last week. After its earnings breakout, no follow through to the upside. Intuitive Surgical flagging nicely. Celsius also flagging, but not really showing any strength. I talked yesterday in last night's video about how every food and beverage stock had broken back below the 21 EMA in our universe, the last holdout being Celsius. SMCI, we got stopped on Celsius yesterday, by the way. SMCI has just been a juggernaut, normal positive action up here near the top. ELF, we want to get back into this. It pulled back to 101 and change today after a great earnings beat. This is just picture perfect on a weekly chart. It's what you look for. We got shaken out back here on the break below the 50-day. We got shaken out before earnings. Uh, couldn't go into earnings with no cushion. Earnings had a great reaction. The stock continues to act great. Any pullback near the 100 level is buyable, with the thought that it should hold the 100 level, as Jesse Livermore would expect. Note the relative strength at a new high, also along with price. Live Nation consolidating after its earnings move up. Palantir has been a beast, still near the top of its weekly range. Toll Brothers, uh, after an outside bullish reversal week last week, consolidating tightly, the best looking chart among the home builders. IGV, this is software money flowing in. This is the big software ETF. CRM getting hit a little bit after hours is a big component of this, so that's why that's down a little bit after hours. But money and relative strength confirming the price move, money flowing into software. SOX pulling back after its big breakout. You see this cup and handle, beautiful cup and handle. How deep was it? Deeper than you'd expect, 49%, but there was a bear market in there, resetting the playing field and a breakout there. Look at how relative strength is where it was when we were trading above $500 here, which we haven't broken near to. So over the course of this big cup, which is 65 weeks long, relative strength got to a new high before price. You always want to see that. And one of the strongest software stocks, MNDY, great day today. For the week, it's up 7.8%. 4 strong weeks up on above average volume, breaking out of a cup base. We need a handle in here, but this is at the top of our buy list. Well, actually, you kind of got your handle here back at 150 after earnings, and now it's up 20% from that 150 opportunity. This looks great. Look at those volume patterns. And I believe that's it. Yes, that is it. That's your weekly look of the 21 over 21. Some nice looking charts in there. We've got only 2 stocks on a daily basis closing below their 21 today. And that's going to wrap it. Reminder of what we do, why we do what we do here at Revere. It's to keep our clients away from severe bear markets. On average, it's a little over 11% from when you top in an uptrend to when you break the 200-day moving average. 11% is a very normal pullback. It's what happens after that 11% if you break the 200-day moving average where your portfolio is at risk. And that's where we specialize in avoiding the serious pullbacks to your portfolio. 11% is fine. Look at these two, another 40 to 46% after that 11% is not fine. You saw the same thing with COVID, saw the same thing Q4 2018, saw the same thing last year. Severe losses down 44%. You need an 80% gain to get back to even. Forget that. We've got rules to keep us out of trouble. And if you're interested in this approach, you can email me, don@revereasset.com, or the phone is 855-REAL-WEALTH. That's 855-732-5932. So wrapping up the month of May and starting the last month of Q2 tomorrow. This is Don Vandenbord with Revere Asset, telling it like it is. Remember, it's not how much you make in the market, it's how much of that you can keep. Thanks for listening and have a great day.